Welcome back to the deep dive. Today, we are strapping on the snowshoes and taking a really close look at the Mammoth Lakes, California real estate market.
Yep.
We've gone through the comprehensive year-end summary for 2025. And our mission here is to get past just the raw numbers and really understand the deep psychological shift in this iconic mountain town.
Right.
When you look at the big picture, the main descriptor for 2025 is actually pretty crisp.
It is.
Balanced, selective, and resilient. After the sheer volatility of the past few years.
Oh, man, the peak time.
Exactly, the peak times. All that rapid appreciation, inventory so tight you couldn't breathe. Bidding wars were just the norm. 2025 was a definite return to something, well, normal.
And that context is so important for you to grasp. This was not a story of decline. Values held pretty steady.
They really did.
They were supported by, that strong lifestyle demand and very stable long-term ownership.
Yeah.
So the main takeaway is that 2025 was a thoughtful market.
Thoughtful market. I like
Yeah.
that.
Yeah. Strategy, due diligence, preparation.
Yeah.
All that mattered way more than just being the fastest.
It sounds like the frenzy is over. And patience is back in. Okay, so with that said, let's jump right into the most active part of this market.
Condos.
It's always the condos. This segment really drives the volume in Mammoth. The headline summary is, well, we saw a lot more units sold, which drove up the overall price numbers, but they took longer to sell.
And to put some hard numbers on that, total condo sales hit 275 units.
Which is a solid jump over 2024.
Very robust 13% increase, yeah. The reported median sale price also got a lift. It rose 14% to $825,000. And the total volume,
That's a big one.
that shot up 38% to nearly $299 million.
So on paper, it looks like a massive boom year.
It does look like a massive jump, but this is exactly where we need to be thoughtful about the data. We have to look past that top line number. That huge increase in price and volume was seriously impacted by properties closing that had been, they were under construction and under contract for sometimes over a year. That's the key nuance. These were not your typical resale deals. These were often luxury new construction units.
With very high price tags.
Extremely high price tags. We're talking an average purchase price north of $2.9 million for just that group of properties.
Wow.
So, when you close 20 or 30 of those high-end contracts in a single year, it's going to dramatically skew the overall median price and the total volume.
Right. It's really important for you, the listener, to realize this doesn't mean your typical two-bedroom condo suddenly shot up 38% in value overnight.
Not at all.
So if we strip that out and look at the pure resale market, which is what most people are actually buying and selling, the details get a lot clearer, a lot more selective. Let's talk about pace.
Right.
The median days on market, or DOM, that's how long it took for the median closed sale to go from listing to contract.
And it stayed pretty consistent with 2024, sitting right around 71 days.
But what does that consistency really tell us?
It tells a very selective story. Well-presented, updated, and, correctly priced units. They still moved fast.
They'd hit that 71-day mark or even better.
Or better, yeah. But the dated inventory, or anything priced too aggressively based on, say, 2021 or 2022 hopes.
Oof, they sat.
They definitely sat.
Yeah.
Those units needed big price cuts and much longer marketing periods to get sold.
And we see that selectivity reflected in another key metric, too. If the overall median price went up because of those big new projects.
The median price per square foot actually softened a bit.
Right. It saw a slight decrease. It dropped about 3.5% to around $675.
And that right there is the ultimate indicator of buyer prudence. It's so telling.
How so?
Well, when the median price rises, but the median price per square foot drops, it means that while the high-end volume is up,
Driven by those big new builds?
driven by those large, expensive new builds, the average buyer is still paying very close attention to value and condition in the resale market. They were willing to pay a premium for quality, absolutely, but they were very resistant to overpaying for, a tired unit.
Okay, so condos were active, but selective. A bit split between high-end new builds and a softening resale market. That brings us to single-family homes, or SFH.
A totally different story here.
A very different story. This segment showed extreme stability, really contrasting that condo volume boom with a much more sedate and resilient pace.
Consistency was the absolute word of the year for single-family homes in 2025. Total sales held steady at 63 units.
Which is almost a perfect match for 2024.
Almost identical. And the median sale price flatlined at $1,300,000. No major change there.
Okay, but here's where the details get interesting again. The median price per square foot for single-family homes actually saw a strong increase.
It did. It rose pretty robustly by 7.6% to around $637.
So why would the overall median price stay flat, but the price per square foot jump up like that?
That's a great question, and it really speaks to the supply shortage in that sweet spot of the market. It strongly suggests that the homes that did sell were maybe a bit smaller or just highly desirable, or they simply commanded a higher quality premium per foot. When inventory is that scarce, the homes that are available are often the ones that are perfectly sized and well updated.
And that pushes up the per foot value, even if the overall transaction size stays the same.
Exactly.
And what about the pace here? If the condo dom was consistent, what happened in the single-family market?
The pace slowed down, noticeably. The median days on market for closed single-family homes rose significantly to 87 days.
That's a 19% increase from 2024.
It is. Buyers were absolutely taking their time. And this is where we need to talk about the idea of low seller leverage.
So when you say low seller leverage, break that down for our listeners. What does that actually mean for a seller trying to make a deal in Mammoth?
It means the seller just doesn't have the power they did back in that frenzied market. They can't dictate all the terms anymore, or demand non-contingent offers, or refuse any and all repairs.
The power has shifted.
It has. Low leverage means the buyer has time. They have time to do their inspections, to negotiate based on what they find, and to ask for repair credits or closing cost help. If a seller wasn't perfectly priced or prepared, they lost leverage every single day their home sat on the market.
That brings us to what actually worked in this segment. We saw updated, well-maintained homes perform the best. Things like garage space, good natural light, or even ADU potential.
Right.
Why are those specific features so critical in a mountain resort town right now?
Well, it's all about utility and financial offset.
Right.
Garage space is just crucial. It's a lifestyle necessity that protects your expensive gear, your skis, snowmobiles, cars from some pretty severe weather.
Sure.
But the ADU potential, the ability to add an accessory dwelling unit, that's now a major driver. And not just for guest space.
It's for the income potential.
It's for the financial offset, exactly.
Yeah.
With the rising costs of things like insurance and HOA dues in these mountain regions, the potential for a reliable rental income from an ADU has become a key factor in making the whole thing more affordable.
Okay, if that's the activity side, let's talk about the structure holding it all up. Inventory and financing. On the inventory front, we saw a much-needed return to normal.
A huge relief, really.
Yeah. Combined listings in 2025 followed a clear, very healthy pattern. They rose through the summer, and then they eased off toward the end of the year.
That return to a predictable seasonal inventory pattern is the very definition of a balanced market. Inventory was definitely higher overall compared to the crazy low levels of 2024.
It's still within historical norms.
Right, firmly within long-term historical norms. And crucially, this gave buyers options. But because most sellers are long-term owners with solid equity, they weren't forced to just slash their prices.
So the market's settled.
It settled into a sustainable rhythm. It's driven by people who want the Mammoth lifestyle and see the long-term investment value, not by speculators.
And that sustainable rhythm got a huge boost from what you called a breath of fresh air in finance interest rates.
Yes.
After years of just crazy hikes, rates finally stabilized in the low 6% range by the end of the year. And we have the specific numbers from early 2026.
We do. For a conforming 30-year fixed mortgage, the prevailing rate was 6.19%. For jumbo mortgages, which are pretty common in a place like Mammoth, it was 6.36%. That stabilization was, I think, the most critical psychological shift of the entire year.
So tell us about that psychological shift. Did that stability immediately cause a flood of new buyers, or was the effect more subtle?
It was subtle but really foundational. I mean, these rates didn't trigger a massive buying spree, but they did restore confidence. Buyers could actually plan again.
They weren't chasing a moving target anymore.
Exactly. They moved away from that volatile, almost panic buying feeling where rates change every single week. This predictability was especially helpful for the jumbo loan buyers who had been extremely cautious. It just let people factor the cost of capital into their long-term planning and make steady, thoughtful decisions.
Okay, let's pull all these drivers together and see where the market really split apart. The sales pace was solid, but that performance gap between properties just got wider and wider.
I really did.
The homes that sat were the ones with, let's call it aspirational pricing or a lot of deferred maintenance. But the standout properties, they moved much closer to that 71-day median.
And this brings up the essential issue of absorption, which is the real measure of who has the leverage in different price tiers. Prices pretty much flattened after years of strong growth, which, again, is a healthy and expected shift in a maturing market.
Right.
But if you analyze the absorption rates, meaning if no new homes came on the market, how long would it take to sell everything currently listed? You see completely different markets operating in the same zip code.
Okay, give us those absorption numbers. This is the real leverage story.
So condos, overall, they averaged a pretty manageable 4 to 5 month supply. But the single-family home market, under $2 million,
Yeah.
it remains shockingly tight. It was balanced, sitting at only 2 months of supply. That is basically a seller's market.
2 months.
Wow. But the story completely flips for luxury homes above $2 million. That tier saw a much, much longer absorption, a full 12 months of supply.
A 2-month supply versus a 12-month supply. That is the entire story of leverage right there. It suggests those high-end buyers have incredible patience and negotiating power.
Absolutely. I mean, if you're the buyer looking at that luxury listing that's been on the market for 12 months, you know you are not competing with anyone.
We're in the driver's seat.
Completely. You can take your time, you can ask for significant price concessions, or demand that updates get done before closing. That massive supply gives those high-end buyers so much more power than the typical buyer looking for a mid-range family home.
So while pricing and supply were manageable for most, let's talk about the biggest headache, the thing that really complicated transactions, especially for mountain properties.
I know where you're going with this.
We just keep hearing about the insurance challenge.
Insurance and risk. It remained a massive challenge across the whole region. Early preparation and just proactive coordination were absolutely essential to get a deal to close smoothly.
And it was especially tough for condos, right?
We saw so many cases of condo complexes in particular getting their policies canceled or seeing premiums increase by double, sometimes triple digits. It just adds a huge layer of complexity and due diligence for the buyer. You had to have your financing and your insurance plan locked down well in advance.
So for you, the listener, whether you're thinking of getting into this market as a buyer or a seller, what are the actionable takeaways from 2025 that you need to carry into 2026?
For buyers, the message is pretty clear. You have time, you have options, and you have more negotiating power, especially if you target some of those listings that have been sitting for a while.
And for sellers?
For sellers, success really requires realistic pricing and a strong presentation. The market is consistently rewarding preparation and planning now more than ever. And that planning, it isn't just about the price. It's about making sure your home is insurable and well-maintained before you even think about listing it.
Okay, so moving into the 2026 outlook, it sounds like we should just expect more of the same, a continuation of this balanced, deliberate approach.
That's the most likely forecast, yeah. Inventory has normalized, so there's choice out there, but most sellers are also in a good financial position.
Which limits any real downward pressure on pricing.
Right. It limits any aggressive downward pressure. We expect that well-priced homes will continue to sell steadily, but that aspirational pricing is going to require adjustments or just a much longer wait.
And based on the sales data, it seems like condos are going to keep driving most of the activity, especially in those mid-price ranges, while single-family home demand stays strongest below that luxury tier.
And finally, interest rates. They're expected to stay relatively stable, with maybe some potential for modest easing.
Which could help a little.
It could. Even small declines could support steady demand and slightly improve affordability, but we are not forecasting a return to those historic lows that would cause another boom. The market is going to move forward at a steady, manageable pace.
So success in 2026, then, it really depends less on timing the market perfectly and more on pricing, preparation, and strategy.
Exactly. It's a theme that defined every positive outcome in the data.
It seems like we fundamentally shifted.
We have. Mammoth Lakes has moved from a market that was defined by urgency and speculation to one that's operating on a sustainable rhythm, driven by long-term value. So whether you're buying or selling, you have to recognize that in this balanced environment, strategy and real local insight, those are the absolute keys to a smooth and successful deal.
And as we close out this deep dive, here's a final provocative thought for you to consider. Given that extreme difference in absorption rates, just 2 months of supply for single-family homes under $2 million versus a full 12 months for luxury homes above $2 million, what does that disparity tell you about the fundamental nature of demand? About the difference between, say, core housing versus a purely discretionary lifestyle purchase in a mountain market that has completely shed the mania of the pandemic boom?